Welcome, everybody. Thanks for joining us again on our market update webinar. We enjoy doing these. We're going to give everybody just a few minutes to queue up on the call, and we'll take it away here in just another few seconds. Hope everybody's having a good day and enjoying the rest of your summer. I think they call these the dog days of summer, or we just came out of it. And some of the hottest days on record, especially on the Crystal Coast. So just for a quick introduction, I am joined today with my colleagues, J.A. Canady and Tara Gould, and I'm Greg Patterson. We're excited you're with us, and we're going to take the next few minutes, probably 40 to 45 minutes, to go through an update with you and just share some perspective on where we are. Interestingly enough, if you're a history buff, you'll recognize the date of August 15th being, well, at least 53 years ago, it being the Woodstock Music Festival in upstate New York. And then 253 years before that, you had Napoleon Bonaparte was born on the island of Corsica. So we're going to keep the time frame a little bit shorter than that. We'll stick within the last quarter or year-to-date results and just share some perspective on the market. So let's take a look at our agenda for today. And by the way, if you have any questions, we welcome feedback and questions. Just email them over to Mackenzie@myatlanticwealth.com. That's MACKENZIE. And she'll be sure to get those questions to us. Also, we can just correspond with you directly through our presentation, or if you have questions about the presentation, we'll respond to you directly afterwards and answer any questions you may have. So let's talk about our agenda today. Similar to past webinars, we're going to talk about current market returns. What's the market doing as of the last quarter and year to date? We're going to take a look at recent economic data. This would be things like inflation and jobs numbers. We're just going to take a look at the overall current economic data. We're going to make sure you understand what the definition of a recession is, and we're going to talk about some of those indicators, both short-term and long-term. We're going to talk about the leading economic indicators, or that LEI index that's put out every 30 days from the conference board. And we're going to show you what that graph looks like. I think that's meaningful in our discussion today. We're also going to speak on where Treasury yields are, particularly the 10-year Treasury yield. And this is the risk-free rate of return that I think we measure all fixed income rates off of. We're going to take a look at energy prices, including gas prices. And we're going to give you a quick overview on the legislation update that just recently was signed, or is going to be signed, rather. It was through Congress. And then we have summary of recent portfolio changes that we've made on your behalf if you're a client. And then we'll talk about some action items and just a wrap up in a conclusion we'll have at the end. So stick with us. I think you'll find this informative. And let's kick it off with market returns.
All right, so I'm going to take you through the next couple slides. There are a few indexes that we closely follow that just give us a measurement of the overall stock market. I know you've seen the S&P 500 quoted. The S&P 500 is an index that tracks the top 500 companies, domestic companies in the United States. And in this index, we saw a low point in mid-June. You can see that circled here, which was in the 3,600 range. Since then, we've bounced around a little bit, but in an upward trend. And today, excitingly, we are nearing around 4,300. The next one, we're just going to take a look at a little more narrow focus. This is the same index, but this frame is 1 month. So over the past 30 days, S&P 500 index, you can see here it's green. Green is good. When we're talking about the stock market, is up 11.14%. To me, when I looked at this chart, what was interesting is the low point, which happened in mid-June, is included in this 30-day chart, that low point that I discussed. in the last slide. To me, this is an example of why it's important to stay invested, because we don't want to miss months like this. Next, we're looking narrow. Now we're going to look broad. This is the S&P 500 over the past 5 years. So this would look at August 15th of 2017 to today. This index is up over 1,800 points, which equates to 77% increase over the past 5 years. Another index that we quote often is the NASDAQ. So this is the NASDAQ composite, and this is comprised of about 3,700 companies. When we think of NASDAQ, we think of tech stocks, and the reason why is because the NASDAQ is heavily weighted in tech. Over half of this index is tech companies. Again, we saw a low in mid-June, and year to date, the NASDAQ index is still down around 17%, but at one point we were down about 30%. So trending in the right direction for sure. And then the last one here, again, a shorter term view. This is the NASDAQ over the last 30 days or 1 month. And from there, we've seen positive returns of 14.4%.
Yeah, and we were just trying to give you a visual of what it might look like over the last year to date. And we thought that it would be helpful to take a trip to the North Sea. Hopefully you've never been on a cruise ship in the North Sea, but if you did, it looks something like this, particularly when a storm was happening. And we were going to mail out the Dramamine to you, but we just didn't do it. But I tell you, markets can sometimes feel like this. And you definitely want to stay on the ship until it gets back to port or gets to a port. You probably wouldn't get back on the ship if you were in these kind of seas. But we certainly would recommend that clients stay invested. And I tell you, I've never had that experience of being on a ship like that, but that looks pretty unnerving to me. But just an example of where markets have been, and they don't stay down forever. They do get back to, I don't know that they'll get to calm seas, but the choppiness is always there. But just realizing that you've got good captains at the helm to help you navigate some of those storms can be very meaningful in these time periods. Because who would have thought we would have turned the corner in June, mid-June, if in fact we've done that. But what we're taking a look at here is just a historical, and the different colors represent different asset classes. So for example, the red represents private markets or commodities, maybe it's orange, reddish orange. The green represents equities, so stocks, and these are both in the US and also outside of the US. And then yellow would be fixed income or your more conservative asset classes, bonds. So let me draw your attention to the far right-hand side. That is 2022. This is year to date. So the top rectangle there is commodities. They have had the best returns this year so far through August 1st is when these were taken. So January to August 1st. Up about 26%. So this would be precious metals, energy, agriculture, those types of securities and investments. And if you look at the very bottom, you have China equities. So international equities related to China is off about 20%. But it does give you some sense of how those have traded places or played musical chairs, as we like to say. Back far left in 2013, US equities held the largest return for that year in the top spot, followed by Japan and Europe. And then at the very bottom, you had emerging market debt. So emerging market fixed income was down 6.6%. It's a great case in point of why we need to be diversified. And I think it helps to put things in perspective for this year. If you notice, the fourth box down is investment grade credit. So corporate bonds that are investment grade or above we're down 13% through August 1st. So historically, a pretty conservative asset class. We've seen some of the worst movement in that sector. But again, a great reason to be invested and diversified and stay invested and not jump out when seas get rough. Jay, you want to talk about some of the latest economic data?
Yes, sir. So as we've been doing these update webinars, we have tried to catch you guys up with what the latest data that's come out has been. And so it's been a lot of data since our last call last month. So wanted to just go through these on a high level to catch you up to speed. Some of these have made headlines as in the news, so you may have heard updates on these, but wanted to kind of sum up the Federal Reserve, employment, personal income, inflation, and then GDP. So I'll start with the Fed. We did have the Fed meet at the end of July, so just a few weeks ago, and they increased rates by 75 basis points. That brings the federal funds rate up to 2.25%, 2.25%. So if you think about starting the year at 0, and here we are at 2.25%, it's been a very fast increase from 0 to 2.25%. Even the thought that the first increase wasn't until March. So we've really kind of compacted things into a very short time period of pretty substantial federal funds rate increases. Jumping to this data, employment data, and many of these have actually surprised to the upside over the last few weeks. So that was definitely the case with the last jobs report that came out a little bit over a week ago. We had over 500,000 jobs created in July, 528,000 to be exact. And they also revised June and May numbers and increased those by another 28,000. So it was a very positive jobs report. The expectations were 250,000 new jobs, so it was more than double what was expected coming out of the July numbers. The unemployment rate also dropped slightly. So we were at 3.6% on the unemployment rate, went down to 3.5% based on those latest July numbers. So very positive employment report and unemployment number. On personal income and consumption, again, these beat out the expectations on both income and consumption. So personal income is up about 5.7% on a year-over-year basis, and spending has increased 8.4%. Interesting that spending has increased more than personal income, but we've seen inflation, right, creep in. So that's part of it. Consumers do continue to spend, at a healthy pace, and so that was positive on the personal income and consumption update. With the CPI, the Consumer Price Index, which is really the big number lately that has been a focus for inflation, we did see that the year-over-year number come down from 9.1% for June down to 8.5% for July. So that's at least in the right direction. And it was a surprise, to the upside, or in this case, to the downside, going lower than was expected. A big cause of the decline in the CPI has been energy prices, which we'll talk about a little bit later. But we've had a substantial drop in those, and that has flowed through to the CPI number. But we'll definitely take it. That is something that the Fed has been focused on as they've been raising interest rates. Their target is to see the CPI rate come down. So that's positive, and we'll hope that trend continues. It's not going to happen overnight. We're not going to get back down to 2% on the CPI overnight, but if we can creep down slowly, it'd be nice for that 9.1% number month before last to be the peak. And I think that's what the market's looking for at this point. On the producer price index, which came out a day or two after the CPI, I believe last week, but the PPI went down as well. So the previous number was at 11.3% and it dropped down to 9.8%, which is a pretty hefty decline. Again, the big driver of that was energy prices. We've talked about before how the producer price index, we kind of like to think of that as a leading indicator for the consumer price index, because producers oftentimes pass along, additional costs to consumers. It takes some time for that to bleed through. So again, that's a positive to see the producer price index trend down as well. We don't, 1 month is not a trend, but again, as we look at the numbers and where we have been headed, we like that things have kind of rolled over, and hopefully the trend will continue. And then on the GDP, or gross domestic product, that's just a measurement of economic activity. And the latest update since our last call was we had the second quarter number come out. It ended up being a negative number, where the consensus expectation was for that to be slightly positive. So it was the second negative GDP number. We had a negative first quarter number, and this first estimate of the second quarter was negative as well, which has caused a lot of the conversation around recession and whether or not we're in recession. And we'll talk about that a little bit later on as well. But that's where we are from a GDP standpoint. As we look at the first half of the year, though, we've had payrolls or jobs growing at over 450,000 a month. We've had lower unemployment, and industrial production has been up over 5%. And those are not things that really happen during recession. So despite the negative GDP numbers, there's still some bright spots that we've seen, over the first half of the year. And in light of all of the news, daily, there's headlines that are out there in the media. It is important for us in what we do to focus on the data, or the facts, really, and really to be measured in our advice and our response. And that's a big part of our job. But the extremes in the media is nothing new. And so I wanted to show you guys this picture. This is a Time magazine headline. Headline says, "Can capitalism survive?" And there's a picture there of Adam Smith says, "Don't count me out, folks." If we were in person, I'd ask you guys to tell me, when do you think this headline was published? But I'll let you guys in on the answer here. It was July 14th of 1975. So again, fear sells, negative news sells, and that's nothing new. We can go all the way back to 1975 and see that. Kind of along the same lines, this was back July 26th, so the day before the last Fed announcement, that Tuesday before. I happened to be just trying to catch up on news, and I saw this storyline headline. It was on CNBC.com, and I thought, this is kind of a microcosm of what we expect on a day-to-day basis in the news headlines, and how they can be very fickle, depending on day to day, hour to hour, minute by minute. But these middle three, so 11 hours ago when I checked it on that Tuesday, it said U.S. Treasury yields edge lower ahead of key Fed decision. Well, the day before, the headline was U.S. Treasury yields nudge higher ahead of the Fed meeting, which was on that Monday. And then the Friday before, the headline was Treasury yields extend retreat ahead of rate hike. So they're going down, they're going up, they're going down. So I thought there was some comedy in that, and just snipped it so that we could review over that and just remind you guys of how, the news is back and forth on a day-to-day basis. And it is important to pay attention to, the source as well. Where's the source? And to focus beyond the headlines on the facts and the data. And that's really what we're trying to do and the job that we do here. With that, I'm going to let Tara delve a little bit more into that with regards to recession.
Yeah, speaking of fear, so now we're just going to cover the definition of a recession. We talked about it in the last webinar, but when we were sitting down and, coming up with the content of this webinar, we just thought it was important to review again. And so the National Bureau of Economic Research, they provide the official definition, and you can read here that a recession is a significant decline in economic activity across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. So remembering that business cycle, recession technically starts at the peak of that cycle and will end at the trough. To note that to date, the National Bureau of Economic Research has not yet declared the United States to be in a recession, even though we've had the economic activity decline for 2 consecutive quarters. And since we began our monthly market updates, each time we want to review this recession risk indicator chart. And it's just been interesting to watch how it's changed over time. Most recently, we've seen shifts in specifically retail sales, shifting from cautionary to recession, and the same with commodities. The next noted change I'll draw your attention to is in the yield curve. It has shifted from that green expansion indicator to a cautionary one. And then in this slide, what we're taking a look at is the current chart, which we just reviewed, of recession risk indicators as compared to other times in history when we've been in a recession, and what it looked like, what those indicators looked like at those times. So in 2020, that was a unique year. I think we can all agree with that. Just a really abrupt and swift recession, while the prior years that you can see have shown many more signs of being in cautionary, or the red X's, which specifically indicate a recession.
Yeah, and so another indicator that we look at is put out by the conference board, and this updates 10 indicators every 30 days. And we think this serves as a good measure for what's about to happen. It's not a crystal ball, but it does give us an insight into those leading economic indicators. And it tallies everything up and scores it, and then gives that to us every 30 days. So once a month, let's say. The last update was recently, so July 21st, and it decreased by 0.8% in June. So the economic activity for June to 117.1, which is on the heels of a decline of 6.6% in May. And it's been down down by 1.8% over the first half of 2022, which has been a reversal from the second half of 2021, where there was a significant increase, 3.3% growth in that second half of last year. So there is a graph that puts this together to show a picture. And if you take a look on the left-hand side at the very bottom, that's the year 2000. And then the gray vertical bars show those previous recessions. There's been 3 since that time. And that would be 2000, 2001 and 2, and then 2008 and early 09, which was the financial crisis. And then we had a small recession in 2020 with coronavirus and the pandemic. So what this chart shows is the blue line going left to right. And you can notice before the recession, before that gray vertical bar, it does point downward for some time. And then there is a drop off, which corresponds to economic activity during the recession. So a decline in economic activity shows up slightly beforehand. And then we see that correspond with the blue line going down. So if you go to the right-hand side of the page, we can see the update of those indicators starting to turn down to point downward. The gray line is just a coincident indicator, so it's like a shoulder to shoulder, you could say, whereas the leading economic indicator is like looking out the front windshield of the car. So it's trying to give us an insight into where do we think the economy's going. And as Tara pointed out, and JA both, this is kind of unique in that we still have strong consumption and jobs numbers, but the data showing in the LEI is certainly pointing downward at the moment. So we continue to watch that every 30 days. I think it's indicative of slowing. Many economists have noted that in the data, and certainly the GDP is one of those indicators, the gross domestic product, so the US economy. And then lastly, looking at the trajectory, what this is showing you left to right is that year-over-year change in the LEI. And then the gray line is the year-over-year change in real gross domestic product. And while they don't always correspond, certainly on the right-hand side where we are year to date, it is corresponding to that with a year-over-year change. It is sort of a rubber band effect. I'll just draw your attention to the 2020 recession. And you may remember the shutdowns and what that did to the US economy, really the global economy. And then like a rubber band, it came right back up to over 13% growth. And then we sort of, trailed off a little bit on these numbers.
Yeah, I think in looking at, the last between 08, 09 and the short recession time period in 2020, you can see that there's been times where there's been times of decline in the LEI in terms of the year-over-year change. So the growth rate has changed without going into recession.
Mm-hmm.
But, we do see that trend right now is on a downward trend in the growth rate.
10-year yields, they are up year to date, but they've declined off the highs. And I just want to make a few comments on why we look at this and why it matters. 10-year Treasury yield is just the current rate that Treasury notes will pay investors if they purchase them today. Just looking at the yield tells us a lot about just the economic landscape and market sentiment. Investors use this as just a prediction of how yields will potentially move over time. It is a benchmark, an economic benchmark. It can influence other interest rates. So when we see 10-year yields go up, so can other borrowing rates. And when 10-year yields go down, and potentially things like mortgage rates falls, the housing market could potentially straighten and it could have a positive impact over time. The 10-year Treasury yield, it also impacts companies and businesses borrowing money. And so when yields are higher, it's more expensive in order to borrow money, which puts a damper on growth and things like innovation. But also the 10-year Treasury yield and its impact on the stock market. Movements in this do create volatility. Rising yields can signal to investors that they're looking for higher return investments, but it could also spook some investors that fear rising rates could draw capital away from the stock market. And on the flip side of that, falling rates could suggest that corporate and those businesses, the borrowing rates could decline, making it easier to borrow. And when it's easier to borrow, we can see expansion, which can give equities or stocks that boost. Energy prices, to me, probably as well as many of you, this has been a welcome relief, but there are some pros and cons to this affecting our overall economy. So gas prices, we're at a high point of over $5. This is a national average, $5 a gallon. And then from last week's data, we're averaging a little over $4, 4.151. So lower gas prices do give a boost to the overall economy. It's cheaper for the consumer to fill up the tank. And we actually saw this evidence with the lower gas prices. JA talked about the inflation rate in July. We saw that decline, and that had I won't say a big impact, but what's the right word I'm looking for, guys? That had a significant impact on that rate coming down, these gas prices. And then one more thing here to do with oil prices. Oil prices, they do have an impact on our economy, and it can go two ways. Like I was talking about before, higher oil prices can drive job creation and investment. It becomes economically viable for these oil companies to exploit some of the higher cost shale deposits. However, high oil prices, they can also hit businesses and those consumers that we were talking about before us with higher transportation and manufacturing costs. Lower oil prices, they can hurt the unconventional oil activity, but can benefit manufacturing and other sectors who are using a lot of that fuel and oil, and the cost of that is a primary concern for that.
Yeah, and usually energy is not the largest expense for a corporation. Probably labor is, but it is one of the larger expenses.
One of the higher ones.
Right? Yeah, so that's been helpful of late.
Yeah, and there's some energy prices built in. I mean, as consumers, just about all that we buy, there's some energy costs built into that, whether it's transporting goods or delivering product to your doorstep through Amazon, whatever it is.
A little bit in everything, right?
Yeah. Cool. That brings us to recent legislation, everybody's favorite topic.
There's a midterm this year, right?
That's right. That's right. Coming up before we know it. But there was some legislation recently that, as Greg mentioned, has been passed. Looks like it's going to be signed. And so we just want to hit the highlights here, not to go into a ton of detail, but just so you're familiar with what we can expect from this legislation. One big thing was increase or creation of a 15% corporate minimum tax rate. So this is for large publicly held corporations, and there's a new minimum tax rate of 15%. It doesn't impact individuals and households. As part of this, they also implemented, or we will be implementing, a 1% excise tax on stock buybacks. So corporations that want to buy back stock now will have to pay a 1% excise tax. Prescription drug price reform. This is something that will impact probably some of you, which they negotiated pricing now to bring down the price for medications, so that folks on Medicare now have a $2,000 cap on annual out-of-pocket drug costs. Does that start this year? No, it's not until 2025. So stay tuned. You have to wait a little bit for it. Although I'm sure that information about not starting until 2025, you will not hear reported very loudly. So the IRS tax enforcement piece of the legislation, this is investing about $80 billion in the IRS over the next 10 years. One of the headlines has been the hiring of new IRS employees. So that's part of that investment in the IRS. But it does happen over time, over the next 10 years or so. The Affordable Care Act subsidy extension. So for folks that are receiving ACA subsidies, we're familiar with some, but they are set to expire this year, or they were set to expire this year before this bill. So now those subsidies are extended through 2025. And then another big piece of the legislation is just around energy security and climate change investments. As far as impacting individuals and households, there are some tax credits for offsetting energy costs for energy efficient items. So I'm sure more details about that will be coming out, but that's something to be on the lookout for. And then we did want to just kind of highlight changes that we've made recently in our portfolios. At the end of last month in July, before the Fed meeting and the GDP number came out, we made some changes across our portfolios that we're managing here. And we did that just based on interest rate expectations and expectations around the economy and markets, both here in the US and the rest of the world. And so just wanted to briefly touch on those changes. For anybody that has any questions or would like to discuss further, we're here and available to do that. But within fixed income, which Greg already mentioned, the volatility this year, we've had really the worst year ever within the bond market, the fixed income market, just due to this transition in interest rates and movement by the Fed. So we did reduce short duration fixed income and we increased our core fixed income. We have previously been slanted more towards short duration with the expectation of rates increasing. And now that we've had some substantial movement in rates and the economy is slowing, we do want to be able to take advantage of higher yields. And so we moved some money to core fixed income. On the equity side, we reduced our international equity allocations. There's still more risks elsewhere in the world than there are in the US, we feel like, with the Russia-Ukraine conflict. There's speculation and talk about China and Taiwan. And, there's also, with China being a bigger player in the global economy, over the last few months, there's been impacts due to their zero tolerance COVID policy. So we just felt more comfortable with allocating some additional funds to the US, and we moved from international to US large company growth and value. And then we increased in our income producing portfolios. We added to our utilities allocation with the thoughts that in a slowing economic environment, that utilities are a place to still receive yield and be a more stable investment. And that brings us to actions to take. And we've talked about this before, but I think these bullet points still remain here, that in market times like this, and really any time, we should always be revisiting our cash reserve amounts. So, do you have more than you need saved up in your bank account, in your emergency fund? Are you on a monthly basis adding to savings and you've eclipsed, that level of comfort that you need in the bank? If so, it'd be a great time to put money into the market, or look at setting up a monthly investment contribution as opposed to a savings contribution. Reassessing short-term spending needs. We've had a pretty good run over the last 4 weeks. So as Tara pointed out, we're still down year to date in the market, but if there are spending needs upcoming in the near term, just to be able to take advantage of this movement that we've had over the last several weeks, we want to talk about that with you and plan around those short-term spending needs. Then just overall changes in your situation, goals, and financial situation, just assessing that. That's something that we want to be included on and made aware of, and that will help us to manage around those changes in your goals and your financial situation, and do our job better when we're aware of those things. Reviewing your financial plan, if there's still concern and some fear, then we always like to go back to your overall plan. We do build in market volatility and down years into our financial plans. And so it's helpful to take a longer term look at where we are and how that looks like over the next 10, 15, 20 years over the long term. And then where appropriate, take advantage of opportunities. We are off the lows that we experienced back in June, but it still remains that the market historically has been up about 75 to 80% of the time and down 20 to 25% of the time. So it's not extremely often where you get a chance to invest or put money in the market or to work longer term money when the market's down, like it is still year to date. And so we'd want to be able to take advantage of the opportunity. We're not market timers, so we've yet to find a person that's able to get out at the high and buy back in at the low consistently over a long period of time. But as I said, we would like to take advantage of times when the market is down, if there is cash and opportunities to invest additional funds. We always say the best time to invest is when you have the money to invest, but especially even so more now with the market down.
Yeah, and I think that's noteworthy too. You mentioned that the plans we put together are built to withstand storms, just like the ship in the North Sea was built to take on that storm. We build your plan not necessarily to go around it, because markets are unpredictable, just like the seas are unpredictable, but to go through it. And generally that has the best results over time. The hard part about getting out is getting back in. Most people can get out when it feels bad or when there's negative news, but newsflash, there is always negative news. It's just hard to emotionally get back in. And I think our value over time is to bring a plan that's time tested to weather the storm and still have positive results. And so reviewing your financial plan is key to that. And you can always let us know if it is uncomfortable for you to be on that ship, to use that analogy. And it may mean that we take a different course, or we adjust risk tolerances or those types of things. But again, just let us know, give us some feedback, and we'll be glad to meet and reassess that. And in fact, thinking about comfort level, we talk about that a lot. Comfort level with different types of investments, comfort with risk tolerance, those types of things. We're always key to go back to biblical wisdom and to help look at this from biblical truths. And this one comes out of 2 Corinthians chapter 1 to speak about comfort and who is the real comforter. Blessed be the God and Father of our Lord Jesus Christ, the Father of mercies and God of all comfort, who comforts us in all our affliction, so that we may be able to comfort those who are in any affliction with the comfort with which we ourselves are comforted by God. So just remember where that real peace comes from. And, I think that's important to keep that perspective during these time periods, especially, but at any time period. And so just as we wrap this up in conclusion, we want to thank you for joining us again. We try to bring these to you on a monthly basis, full of wisdom and practical advice, but also to give you some perspective on where we are. If you heard anything today that resonated with you, or you have questions on it, please feel free to give us a call or let us know. We always love feedback, so we would appreciate your phone calls and emails. And also, if you or someone you know, a loved one, for example, a family member, could benefit from the work that we do or from some of this that we talked about today, feel free to forward this to them or send them to us or introduce us. There's a variety of ways that you can connect us, and we'd be glad to help them. And as always, we consider it an honor and a privilege to serve you and to be your trusted advisor. We hope that you're registered for our upcoming client event on the 25th of this month, where we can spend some good time together in fellowship and friendship and share a great meal. And if you're not able to come, continue to know that you're thought of, and we appreciate you as our client. Hope you guys have a great rest of your summer, and look forward to seeing you at the next one of these next month. Take care.
Bye.
Bye-bye.